here to make an educational video today. This is going to be a three-part series. Part one is all about in-out spreads. So just a little bit about myself. I am an options trader. I've been trading options since 2012. I jumped into it without really knowing too much. So I paid my tuition, had to learn on the fly. And then finally, some years later, I decided to take classes and find a mentor. And that is what really made me the trader I am today. So I want to share some of those ideas and the tools that I have and the certain strategies that I use for certain setups. So let's jump into it. All right. So an in-out spread, it's a real conservative way of playing options. While you're still leveraged, but you can walk away from the screen. You don't really have to worry. You put your play on, you walk away, and a couple days to weeks later, your option will execute itself. So there's not a whole lot of maintenance to it. Real easy strategy for those who can't commit themselves to the screens for hours on end, or you have a main job that requires your time, or family that you can't commit. So this is a really cool play. What an in-out spread does is it offsets theta and vega. I know this sounds kind of geeky. You can look these Greeks up, but I'll give you the short version of it. So theta is time decay. And options, the two biggest factors in an options trade is time and price. So theta is a certain decay. As time goes by with an option, as you're holding it, there's a certain theta decay. So it takes away from the price that you paid for it, in a vacuum if your price was standing still. And over time, it would just decay to nothing. So this strategy actually offsets that. And the other one is vega. Vega is the measurement of price movement. Now this starts to get into implied volatility. Let's say an earnings event is coming up within a month, and you actually, well, you don't typically want to play those with this strategy beforehand. I'll show you some other things later. But what happens with an option before the event comes up, it actually increases in implied volatility, which increases the vega, which in turn increases the price. So you say, oh my gosh, that's a good thing. But, right after that event, your option may even decrease, even if you have the direction nailed down. So let's say on earnings, you're thinking that, oh man, this is going to pop up a couple dollars. This is a great company. It does. The next day, vega, implied volatility, just drop. Well, you hit the right direction, but maybe you didn't make those profits that you're really looking for. So in-out spreads, they counteract that vega as well. And last, and probably the best part for smaller accounts, or like I said, those who are busy doing things, well, it's very affordable. So the in-out spread, instead of taking Apple here, for example, and trading, let's say we're going for a call. Let me delete that real quick. Instead of going for a call at your 70 delta, that's going to cost you around $7.30. So do you have $730 to spend on one stock, one option, or do you actually want, if you have a $2,000 account, that's taking up a big chunk. So the in-out spread will actually take that price and minimize it substantially. And we'll look into those prices as we go through these examples one-on-one. All right, so let me take a break just for a second here. All right, so let's get back into it. The trade setup that I would use this strategy for happens to be one of three would be the consolidation patterns. So there's many consolidation patterns. There's triangles, there's flags, there's inverse head and shoulders. You can look all of those up. They're available online. But this one in particular, I'm using Apple. You see Apple's consolidating. It's taking this a daily chart, so it's taking a lot of time. This it peaked at the beginning of September, and it's really not making this move. Maybe it's starting to make this move around December. So this whole time we're looking. We know that the price might spike back up because our trend is up, and this is a very good example. It's a big consolidation. There's much smaller ones and smaller time frames, but that's why we want to use something like an in-out spread where it gives us time. It gives your options time to make that move. The other one, there's reversals. Now this is more for the contrarian type players. I don't do a whole lot of these. I did in the beginning of my career, but they take a unique skill. So one that I actually just put on yesterday was Marvell here. So we noticed that the price is up at the top of a channel. It's making a reversal candle. It's not confirmed yet. If we're going to take a look at the oscillators later, but they're all skyrocketing, and we just want to play this pullback. Well, we don't know if price is going to push up a couple times before it pulls back. There's tendencies to do that. So this might be another situation where you're being real conservative, and you're giving yourself a lot of time for this price to move back to the downside. Now, just because it's a reversal doesn't mean we're going to go crashing. That's not necessarily what reversals mean. It's just a change in price on the daily time frame. And if it decides to go down here for 2 weeks, 3 weeks, that's a perfect way to use this options strategy. And you're wrong if price breaks out and starts closing above the resistance in this channel. So this is another great option, no pun intended, for using reversals. The other one, we'll use plug. EVs right now, electric vehicles are super popular with Tesla and all those other plays that are involved in plug is one of them. So you see how this price is just trending away up. It looks like it's increasing its momentum as we go, and you just want to play this so bad. You want to be in it, but you want to be conservative. Well, one way to do that is to use an in-out spread. Every single time frame, momentum is just skyrocketing. So yeah, just go ahead and put this on and let it go. Okay, so the next thing is our market trend. This is the biggest factor in the in-out spread of sticking with that trend, or obviously the reversal is the opposite of that, going counter trend. But sticking with the trend, that's our main way of knowing how to put the trade on. We're going to look at a couple different time frames, and if all those time frames, or at least 2 out of the 3, line up, then this may be the trade for you. You may be able to put this trade on. So what we're going to do is we're going to move on to our checklist, and then from that point, the directional bias is in there. So let's move on. So the first thing when you're looking at, you want to play plug. Well, you need to know if this is liquid enough. Are you going to be able to get in and out of your trades? So go ahead and go to the trade tab. Expiration, it's down in the list there. Does this have weeklies? These have weeklies. So there's going to be some liquidity in this play. So check, we have weeklies. Directional bias, that's when we go back to the chart. And we're going to start off with the monthly time frame. Wow, look at that. Parabolic. All right, and so this is where the MACD comes in. And with the MACD, it easily just shows you momentum is up, clearly. So we'll move down to the weekly. Wow, it's just momentum straight up. Daily. All right, so at one point, the trend was down. So we may have looked at this and said, I'm not sure if we want to play this play because it doesn't coincide with what's happening with the other charts. So maybe we should let this go down. It could have came all the way back down here for all we knew. Well, plug started to move back. It crossed its leader. It's crossed the blue MA. The yellow line is the leader. It started moving up. So momentum's up on all three charts. This is a perfect candidate. It's very volatile. So if we were playing weekly options, we might get whipped around and lose money each and every way because we don't know if it's going to move down or up, within a week or within days or hours. So we want to be conservative, and we see the momentum's flying everywhere. So we're even going to go down to the hourly chart to put our position on. And we're not looking at price at this point. We're just looking at the momentum. So the momentum is all the way up top here. It's looking like it's wanting to come back down. So we may want to have a little bit of patience on this one to put in our option strategy. We may want to look for the hourly to come down a bit. But if you don't have time to do that, all three are actually headed up. So if you put enough time out on this in-out spread, 30 days, 40 days, then you may be in the clear. But let's say, prices come down to this midline and it's starting to come back up. So, wow, perfect entry. So what we would do at that point is we'd go back to the trade tab. And we want to look for the expiration. We want the sweet spot, in my opinion, is around 30 days. So I usually look around there. It allows you a little bit of error. If you know exactly what you're doing, you're pinpointing that reversal or the perfect positioning for your strategy, you could go down to 9 days. But that doesn't leave you much room for error. And the whole point of this is to be conservative. So you have about 9 days, and if you're going out to 50, or even in this case 41, you may be setting yourself up for failure in just a way. Maybe there's a little bit too much time, because with this strategy, as price moves and as time goes, your option that you sell against the option that you buy, we want that to decay. We want the option that you sell, and I'll go over this one more time. This gets kind of confusing if you're not familiar with the options, but the option that you sell, we want that to decay over time as the price is moving up. That's what's going to increase our profits as we go through time and price increase. If the price starts rising right off the bat while we're in our trade strategy, right in the beginning, in the option that we sell, in the beginning, it's not offset. So we want to keep the expiration around 30 days. That will be our sweet spot. Now, building the trade. All right. So for a call spread, a call biased in-out spread, where we think price is going to go to the upside, we want to choose one price that's in the money, that's in this purple area. So we'd call that the strike price 31. We're going to click on that and build one leg of it. And we want to sell an out of the money option at about $2 away from it. So if we sell the 33 against the 31, we're looking at about an 83-cent debit. So let's that's a little bit, yeah, that's fine, but we want to be a little bit more conservative. So let's go down to the 30 strike. Let's build that call. We're going to buy that call option and then sell the 32 against it. Again, one that's in the money and then one that's out of the money. That's more of our, okay, that's right in our price area of 98 cents. That's perfect. We don't want to pay more than, at least for a $2 wide spread, we don't want to pay anything over $1.05. Otherwise, our risk reward is getting offset. So right at around $1 is perfect. If you don't know about spreads, please look those up, just the general spreads. But a 32 spread, that's $2 wide. The max that you can profit off of a spread that's $2 wide is $2. So the risk reward, if we're paying $1 in order to make 2, then we would that would be a risk 1-to-1. But this is real conservative option strategy. So you'd say, why would I take 1-to-1? Well, because your probabilities are really high. So really good way to make $1 off of $1. I mean, your probabilities, I got this written down later on, are around 65 to 85% probability of winning. And that's wonderful for option strategies. It's actually, it's probably a little bit more than that. But that's how we define it. Okay. So the 1-to-1 risk reward, we don't really want to go for anything that's more than $5 wide strategies. For example, maybe Amazon, they only have strike prices that are $100 apart. Well, that's not in our game. We want to keep it down to a little bit lower, like Apple. Maybe they have $5 wide strikes, and we want to limit it to that at this point. This is a little bit more of a beginning strategy, very conservative. We don't want to mess with huge dollar amounts for the underlying, such as Amazon. All right, so when we're setting the trade, going in the 30, selling the 32, we want to work the trade. Now, working the trade, you want to do this for every trade strategy. If it comes up as 98 cents, maybe go down to 95 and let it work. Give it 10 to 30 seconds after you confirm and send to work the price. If nothing's happening, raise it $1 and then do that same thing again, confirm and send it. And you may get that little bit $1 or $2 advantage when you're setting these, and that matters because that's a percentage of your wins, because you're gonna set this and walk away. Don't force the trade. I mean, don't just go at market price and say, okay, 90 cents, 98 cents. Well, I want to be in it right now, so I'm going to raise this up to $1. I just got to be in it. That's just FOMO-ish. That's very emotional. You just want to work the trade. You have time. That's why we're doing this. We have time on these trades. And so what we're going to do at this point, let's say we get the trade over at 97 cents. We worked it at 97 cents. We're going to go over to, and this is going to be different for every single broker, but they all have the GTC. And if they don't, then you're working with the wrong broker. So right now it's set at the day. That means if you work your order, you know what? I'm so sorry. This is after we send our trade out. We want to automatically sell the trade. So when we go to sell this trade, we're going to go and immediately go to GTC. That means good till canceled. So we already have this trade placed. and we're going to move it to sell and buy, and we're gonna go over to our handy calculator. We got it at 97 cents. So we want this. We want to exit out at 55%. So what we're gonna do math-wise, 97 cents times $1.55. That's 55%. And I'll give you your total. It's $1.50 that we're gonna set our good till canceled order in at. So 1.50, and then we'd confirm and send. Now, as soon as that price, a couple days, not a couple days, a couple weeks, few weeks later, you don't have to do anything. It's going to sell for itself. So let's go over that one more time. Okay, we're buying. We're going to set this up. So the 30, we're going to buy the 30, call, sell the 32. We're going to work the order. Let's say we get it at 97 cents. We're going to confirm, send, trade goes through. Immediately after the trade is executed, we're gonna sell that trade. We're gonna put a good till cancel order. Do the math. 97 cents times 55%. You put the 1 in it, so it just adds everything together and gives you the total. $1.50. Good till cancel, confirm, and send. So then you just let it go. You don't have to look at anything. You can kind of monitor it a few days later, week by week, but it will take care of itself. Now, when I guess the question is, when do you get out? When if your time is expiring and you're 4 days before expiration, don't mess around with it. Just go ahead and get out. Just get out of the trade. Maybe you can get a few cents out of it, 10 cents, 20 cents. Let's say if it went the wrong way or it's not doing anything and your time is about to expire. 4 days before the expiration is a very good spot to do it. Just get out. Take what you can, because those 10 cents matter. Those 15 cents matter. That's $10, $20, $15 that you can use towards the next trade. And being a very conservative trade, that's a percentages of your wins or losses. So you want to take what you can away from it. Okay. Now, in the first 3 days after you put your order in, just check it. If in the first 3 days your option, let's say plug, just skyrocketed tons more, and you're already 30% up on your position, get out. Just get out while you can. It's an amazing win. That 30% within 3 days, execute it. Get out. All right, and just to reiterate, this is a 65 to 85% probability of winning. It's a very conservative trade. It's gonna win for you most of the time, and it's all about repetition. So you do these over and over, and you're gonna win. You're gonna come out on top. Honestly, this is this is like a 90%. I don't remember the last time that I actually lost on a in-out spread. I don't use them as much anymore, but they're super conservative. I highly recommend those who don't want to be on the screen all day long. This is a strategy for beginners. For those without time, I highly recommend it. So I'll give you one more example. Let's go back to Apple. Just so we're clear, we're going to go through the checklist. Let's check out liquidity. Everybody trades Apple, so we know there's weeklies. Check. Directional bias. Let's go to the charts. Monthly. Look at that. Beautiful monthly momentum. Weekly. Wow. We're coming down, but we're starting to curl up. So that's a really good sign of consolidation and moving back to the up direction. So we don't quite have the check mark on the weekly, but we have that monthly. And let's look at the daily. Ah, yes. So the daily is coming back to the upside. So this one, that's the even more reason to pick an in-out spread, because you have 2 out of the 3 check marks, but we are curling up on the weekly. So that is acceptable to get into this trade. Now, if you go to the hourly momentum is down. So we may want to use this opportunity. You see the consolidation happening here. We may want to wait till the next day or 2 to start seeing the price curl up again. So that's beautiful to have patience. Now, if you don't have time, you can put this trade on. It's just going to take a little bit longer for you to make your profits. And so you may want to look at not only 27 days, but maybe 35 days out to give that a little bit of extra time to start curling up. But just know that if you wait and you're patient, then you can get a better positioning on this hourly chart, and then you'll execute your trades a little bit faster. You'll be able to make that profit just maybe a couple days faster if you have patience. Okay, so we have the directional bias. Let's go back to the trade tab. Expiration. We like that 30-day area. So 27 is really good. We want to do one option in the money. These are $5 wide spreads. So we're going to do one right next to each other. The 125 call. Let's bring that up a little bit. And we're going to add on the other leg. Sell the 130 call. And it looks like it's pricing out about $2.35, which is underneath half. This is a $5 wide spread. So anything up to $2.50 is very acceptable. So $2.35, we want to work our price here. So $2.30, let's start there. Let's say we go ahead and get that price executes. So we now have a in-out spread. The next thing that we're going to do, and this step is going to look a little bit different when you're going to go to your actual trade, and you're going to sell against it. Well, you executed at $2.30, so we want to multiply that by $1.55. That's the 55% tacked on, and that gives us $3.57. So to execute our price here, $3.57. Good till canceled. You send it, confirm, and now you walk away. So it's as easy as that. Then you watch Apple hopefully go to the upside, follow that momentum. And yeah, this is it. Real easy. If you have any questions or concerns, or you just want to comment on this video, just let me know what you think of it. I'll answer any questions in the comments. I hope you enjoyed all of this. This is one of my favorite and beginning plays to do. And we'll move on to part 2 coming up next week, and then 3 the week after. Just to let you know ahead of time, next week we'll do call spreads. It's very directional. And then after that, we'll do naked calls. So stay tuned and appreciate you joining me. This is Options Tender. Good luck trading.